So we'll now move on to reading number 30 of the CFA level 3 curriculum that will tell us some risk management strategies using options. Now, futures and options originally came in as risk management instruments. Options particularly helped us retain the upside while limiting our downside. The first strategy that we'll study with the help of options is referred to as the covered call. In a covered call, we are originally short a call option. So we wanted the upfront premium and we short a call option. Please tell me, what will be the risk in this strategy? That is a short call. The risk is that the stock goes up. If the stock goes up, a short call position can theoretically have an infinite loss depending on how much the stock goes up. I short the call option and now I've realized that actually this stock is going to go up. To cover my position, what I can simply do is long a corresponding call. Of course, that call will be expensive, so there's some upfront loss that I may need to book, but at least there will be no possibility of any further loss. So long a corresponding call option, that will simply solve this problem if you're sure that the stock is going to go up. However, let's assume the option markets have become illiquid and a long call option now is not available. So to cover this short call position in a covered call, we simply long the stock in the hope that if the stock goes up, a long stock position will definitely gain. So a short call position is combined with a long stock position, and the resulting strategy is referred to as a covered call. So this is a short call combined with a long stock. Let's now try to see the combined payoff on this strategy. At maturity of this option, let's assume if the spot ends up equal to the strike, that the stock actually didn't go that up. In that case, the option will not be exercised, or even if it is exercised, there will be no loss. My gain will simply be equal to the premium that I received when I short the call option. Assuming that the stock was purchased at the strike price, there will be no gain or loss on the long stock position. As the stock price moves below the strike price, the option position will still get me the premium. However, incrementally I will start having loss on the long stock position. So this payoff will start going down, or there will be a loss on the long stock position. Please note these are all 45-degree lines. A 1 unit increase in the spot price would mean a 1 unit increase in profit. A 1 unit decline in the spot price would mean a 1 unit decline on the profit. In all diagrams that I will draw, even though I may not write it, the y-axis means the payoff or the profit and loss, and the x-axis is the spot price at maturity. If the spot starts to fall below K, I will start losing on the long stock position. This option will give me K, but to the extent this loss is there, will come. It will be helped because there's some premium I've received, but this loss will still be there, helped by the premium. More interesting is what happens when the stock starts to move above the strike price. I will still continue to have a loss, or rather a gain on this long stock position, but any incremental gain will exactly be offset by a corresponding loss in the short call position. So if the stock moves up, there will be a 1 unit gain, but if the stock moves up, there will be a 1 unit loss in the short call position. The resulting payoff will be plateaued. So after this point, any up movement will not give me any gain, will not give me any loss. So the green line depicts the payoff on a covered call. We were short a call option and we long a stock, and the resulting payout is the dotted green line. This payout looks like which instrument? A short put option. So please remember that a covered call converts a short call into a short put. As a short put, if the stock is greater than the strike, I receive the premium. Put will not be exercised. As the stock moves below the strike, I start losing, or the long starts coming in the money. So covered call converts a short call into a short put. Please note, on the exam, I don't expect drawing these strategies to come. However, you must generally try to remember the shape of the green line that I'm going to draw in all the diagrams. That is the final payoff. You should try to just remember in your mind a little bit. As far as solving questions on options is concerned, there is just one trick that I will tell you, and that will be applicable across strategies, across questions, on any question on option if it comes on the exam. So let's do one question and understand. An investor buys a script for $52 and sells a call for $5 with a strike price of $55. Show the expression for profit and compute the maximum profit and loss and the break-even price. Now please remember, on any question on options, the first thing that we will do is that we will draw a timeline or a line and represent the different strike prices of the options that exist in the question. So just go and look in the question and see what are the different strike prices that you see. It doesn't matter whether it is a covered call or a short put or any strategy. So there is only one strike price, the strike price of 55. It's a relatively easy question. So we have one strike price. When computing the expression, you will compute the expression for all ranges defined by the strike prices. In this case, there will only be two ranges, one when the spot is less than 55 and one when the spot is greater than or equal to 55. There is no other alternative. The reason we do this is because in both these cases the payoff expression for the option will differ. So we will compute two separate expressions. Now let's first compute for S less than 55. So he is long a stock for $52. Whatever be the stock price, the payoff on the stock position will simply be S minus 52. Wherever it may be, stock will be the stock price minus 52, that is the payoff on the stock position. He sells a call for $5. On the call position, come what may, the $5 premium he has already received. If S is less than 55, then it's a call option. It's a call option. So call option comes in the money only if stock is greater than the strike. If S is less than 55, incrementally there will be zero payoff on the option. And if S is greater than 55, then the long party will exercise the option. The long party will have a payoff equal to S minus K, that is S minus 55. I am short the option. Incrementally I can only have a loss. I will have a loss equal to minus of S minus 55 if S is greater than or equal to 55. So I now just need to sum these up to compute my profit expression. If S is less than 55, the payoff will simply be S minus 52 plus 5, that is equal to S minus 47. If S is greater than 55, the payoff will be S minus 52 plus 5, that is S minus 47 minus S plus 55. This will sum up to $8. So if S is greater than 55, the payoff will simply be $8. If S is greater than the strike, the payoff is 8, and after this it is S minus 47. That's why we say it is like a short put. If F goes up, it's a fixed payoff. So expression for profit has been computed. This is the expression for the profit. Maximum profit is what? The maximum value of S, if S is less than 55, if it is 55, it will be 55 minus 47, that is $8. And if it is greater than 55, then anyways I have to look at the second expression, so it will be $8. So maximum profit is nothing but $8. Maximum loss is if S goes down to 0. In the worst case, S can go down to 0. So maximum loss will be $47. And the break-even price is where there is exactly no profit, no loss. Again, when S minus 47 is equal to 0 or S is equal to $47. So break-even price is when S is equal to 47. Compute the profits when the stock price is $0, $45, 50, 55, 60 and 65. Now once we have computed the expression, all this is very simple. If S is less than 55, it will just be S minus 47. So 0, it will be minus 47, 45, it will be minus 2, 50, it will be plus 3, 55, I can see it here or here, it will be 8, 60 will be 8, 65 will be 8, anything greater than 55, the payoff will be 8. We will do many questions of this type so that this concept is understood. But please remember, in every question henceforth, we will do exactly the same thing to solve the problem. Of course, understanding the strategy is going to be a little more complicated, but I don't expect you to be drawing diagrams on the exam or the actual depiction of the strategy to come. But yeah, just generally remember how the dotted line or how the shape looks. The second strategy that we'll study is called a protective put. So in a protective put, our original position is that we are long a stock. So to begin with, we are long stock. If we are long stock, then our payoff will look like this 45-degree line. If the stock goes up by 1 unit, my payoff will go up by 1 unit. If the stock goes down by 1 unit, my payoff will go down by 1 unit. The risk in the strategy is what? It's just a long stock strategy. Stock will go down. If the stock goes down, I will have a loss. To hedge this risk, we can simply buy a put option. So I combine a long stock position with a long put position, and that is called a protective put. The long put will expire worthless if spot is greater than the strike. As the spot moves below the strike, the put option will start coming in the money. Again, a 45-degree line. Try to draw this a 45-degree line, okay? If you are drawing it, it will just make the diagram better and you won't have any complications. So these are the individual components of a protective put. Let's now try to draw the combined payoff. We'll represent it with the green line. Once again, if S is equal to K, on the stock position there is no profit, no loss. On the option position, because I am long the option, I will lose the premium. So this is where I will be if spot ends up equal to K. As the spot moves above the strike at maturity, the spot ends up above the strike, I've lost this premium, but I will start gaining on the long stock position. So as the stock moves up, I start gaining on the long stock position. As the stock moves down, or rather if the spot ends up below the strike price, I will still keep losing on the long stock position. That's not going to change, or rather I'll start losing on the long stock position. However, my long put option on which I had paid the premium up till now, I will now start gaining or now start coming in the money. So any incremental loss on the long stock will be made up for by the gain in the long put position. Any 1 unit decline in the stock price will cause a 1 unit loss on the stock, but a 1 unit gain on the long put. Hence, the payoff will plateau out, or there will be no incremental loss. Again, the green dotted line is the payoff on a protective put. This also looks like the payoff on which other instrument? Long call option. So remember, a protective put converts a long stock position into a long call position. As far as solving the question is concerned, we will again follow the exact same methodology. An investor purchases a stock for $80 and buys a put for $15 with a strike price of $70. Demonstrate the expressions for the profit and the maximum profit and compute the maximum loss and the break-even price. Once again, a question on options. First thing, depict a timeline and depict as many strike prices are there. Spot prices don't matter, no matter how many there are. We just read about the strike price. There's only one strike price again, that is at $70. So there will be two ranges defined by this $70. First, when the spot is less than 70, and second, when the spot is greater than or equal to 70. When spot is less than 70, since I am long a stock, on the stock position, it doesn't matter where we are, the payoff will always be S minus 80 since we have purchased the stock at $80. On the option position, if S is less than 70, then will the put option come in the money? The put option will come in the money and my gain will be equal to the strike price minus S. So 70 minus S is what my gain will be. K minus X is the payoff on a put option. And since I have longed it, there is no option. The premium of $15 is going to go any which ways. If the spot ends up greater than or equal to 70, then on the option position, will the option come in the money? But I still have to pay the premium of $15. So the combined payoff in both circumstances can be calculated. If S is less than 70, the payoff will be minus 80 minus 15 plus 70 minus S. S will get cancelled. This will be minus 25. And if S is greater than or equal to 70, the payoff will be S minus 95. That's what a call option also is, no? At a lower, you lose the premium. As the stock goes up, you gain. So that's the expression of the profit. That is, if S is less than 70, minus 25. If S is greater than or equal to 70, S minus 95. Maximum profit and the maximum loss and the break-even price. So what is the maximum profit? Infinite. If S goes up to infinity, maximum profit will be infinity. Maximum loss is if S goes down to 70 or S goes down to 0. In all these cases, the loss is minus 25. Break-even price is where the profit is exactly 0 or when S is equal to 95. Compute the profits when the price is 0, 70, 75, 80, 90. Again, very simple. We have the expressions. So 0, 70, 0, it will be minus 25. 70, it will be again minus 25. 75, it will be minus 20. 80, it will be minus 15. 90, it will be minus 5. 100, it will be $5. We'll now move on to understanding a very interesting category of strategies called spreads. In a spread strategy, please remember, you buy and sell an equal number of options. So if you're long 2 calls, you also have to short 2 calls. If you're long 5 puts, you also have to short 5 puts. Of course, the strike prices will be different or the time to maturities will be different. So there will be some payoff. If you long and short the exact same thing, it won't make any sense or there will be no payoff. But it's a spread strategy if you're longing and shorting an equal number of options. The first spread strategy that we are studying is called a bull spread. In a bull spread, we long a call option at a lower strike price K1 and we short a call option at a higher strike price K2. Now before we go ahead and understand the strategy further, please answer the following 2 questions. First, if C1 is the premium of a call option written at K1 and C2 is the premium of a call option written at K2, then will C1 be greater than C2, equal to C2 or less than C2, or we can't say. Similarly, P1 is the premium of a put option written at P1 and P2. Will P1 be less than P2, greater than P2, equal to P2, or we can't say. A call option is the right to buy. One person is saying, you can buy from me at $10 whenever you like. Another is saying, you can also buy from me whenever you like, but only at a price of $100. Who will you pay more for? The right to buy at $10. So C1 will be greater than C2. Put option is the right to sell. One person is saying you can sell it to me whenever you like, but at $10. Another is saying you can sell it to me, but at a price of $100. What is more valuable? The right to sell at $100. So P1 will be greater than P2 will be greater than P1 and C1 will be greater than C2. Knowledge of this fact will significantly improve our ability to draw the diagram. So the first instrument is a long call with a strike price of K1. This is a lower strike price, hence it will have a higher premium that I will need to pay upfront. And as the stock goes up, the long call will be in the money. The second call we are short. So upfront we will receive from premium. However, that receipt will be lesser than what we have paid because that is a call at a higher strike price. As the stock goes above the strike now, we will start losing again according to a 45-degree line. This is also a 45-degree line. This is also a 45-degree line. This is the long call. This is the short call. We will now try to depict the combined payoff of the two strategies. So we'll first start with the spot price remaining less than K1. If the spot price is less than K1, which option comes in the money? It's a call option. It doesn't matter whether you're long or short. In the money can only be for the long counterparty. A call option comes in the money if S is greater than K. So if S is less than K1 and definitely less than K2, then none of the options comes in the money. My payoff will simply be the difference of the two premium. One I paid, one I received. What I paid was higher. So the net payoff will be negative. As S moves above K1 but is still less than K2. I had this loss because of the premiums I had paid, but now I will start gaining on account of the first call which comes in the money and which fortunately I am long. So I'm long this call option and it starts coming in the money. So I'll start having a gain. However, my gain will continue until the spot hits K2, after which as the spot goes above K2, any incremental gain that I have on the first call, that will still continue, but it will be offset with the loss that I'll start having on the second call that I was short. So the payoff again will plateau out. So this shape, the green line, is the payoff on a bull spread. Remember, spread strategies by definition are low risk strategies. Our downside is also limited. Our upside is also limited. We have bought a call option also and we have sold a call option also, limiting our upside as well as downside. It's a bull spread because it makes money when the market goes up. Solving the question remains exactly the same, so it doesn't matter what strategy it is. You will first depict your strike prices, define the ranges, and calculate the payoffs for each range. Please solve the question. An investor purchases a call for $5 with a strike price of 55 and sells a call for $3 with a strike price of $65. Demonstrate the expressions for the profit and the maximum profit. So once again, we'll draw the timeline. We now see that there are two strike prices, one of 55 and another of 65. Hence the ranges defined will be when S is less than 55 and between 55 to 65 and when S is greater than 65. If S is less than 55, none of the options comes in the money. There is no stock now, there's only two options. So what we can say is that for the purchase, there will be a loss of $5 and a gain of $3 in all cases. So that we can write on top, because this nothing can change. These premiums are exchanged upfront. Let's see what will be the incremental payoff on the two options. If S is less than 55, the call option also will go worthless, and the put and the second, or rather both the call options will go worthless. First call is on 55 and the second call is on 65. If S is greater than 55 but less than 65, the call on 55 will start to come in the money. Hence the payoff will be S minus 55. On the other call, there will be no payoff, or our total payoff will be S minus 55 minus 2, that is equal to S minus 57. If S is greater than 65, then both options come in the money. On the first option, that is the call at 55, I get S minus 55. and from the call written at 65, I will now lose 65 minus S. Hence the total payoff, S will get cancelled, will be equal to 65 minus 55, that is 10 minus 2, that is $8. So again, the payoff is minus 2, S minus 57 and $8. So this is the expression of the profit. If S is less than 55, minus 2. Between 55 to 65, S minus 57. And after 65, $8. So this is the expression for the profit. What will be the maximum profit? Maximum profit is if S is 65 or greater, that will be $8. Maximum loss will be if S goes down, that is minus 2. Break-even price will be at S equal to 57. Once again, we have all the expressions. So for 0, 45, 50, the payoff will be minus 2. For 60, it will be 60 minus 57. That is $3. For 65, it will be 65 minus 57, that is $8. And for 70, again, it will be $8. So remember, whether it is a bull spread or bear spread, it doesn't matter. This question on options will always be solved like this. Depict the strike prices and then compute the expression for the various ranges. In a bear spread, we do the exact opposite of a bull spread. That is, we short a call at a lower strike K1 and we long a call at a higher strike K2. So at K1, we will short a call option. K1 is a lower strike call, hence you will receive a good premium. And as the stock goes above the strike price, we will start losing. At K2, we long a call option. If we long a call, that means we will lose the premium. And as the spot moves above K2, we start gaining according to this 45-degree line. This is a long call, this is a short call. Once again, let's start with when S is less than K1. So if S is less than K1, which option comes in the money? None of the options. So the payoff will simply be the gain on the, or the difference of the premium of the two options, which will be a slight positive number this time, since what we have short gave us more, what we long took away less. As the spot starts to move above K1, the first option, that is the one that we had short, will start coming in the money. So the buyer will gain and we will have to live up to our obligation and we will have a loss. Till the time the spot becomes K2, we will keep having a loss because of this short call. As the price goes below K2, we will still continue to have a loss on this first option at K1, but we will start gaining on the second option that we had long. So the loss will start to get offset by the second call that we had long. The resulting payout will flatten out. So there will be a positive. We will start to have a loss, and then there will be a plateauing out again. So the upside is also limited, the downside is also limited. This strategy makes money when the market goes down, hence it is referred to as a bear spread. So in a bear spread, the shape is like this. It makes money when the market goes down. Again, upside limited, downside is also limited. Similarly, an interesting strategy is called the butterfly spread. So in a butterfly spread, we long a call option at K1. We short two call options at an intermediate price K2, and we long another call option at a higher price K3. So we are long an option and we are long again. So we are long two call options and we are short two call options. Hence it is also a spread strategy. Let's again first depict the payoffs on the individual instruments and then we'll depict the combined payoff. So on the first call, that is at K1, we are long this call option. So our payoff will be depicted as a heavy premium at the beginning, but as the spot goes above the strike, we'll start coming in the money. The second calls, the two calls we are short, the individual premiums will be lesser than the first call. However, we are short two options. So it will be double the payment that we will receive. Till the time the spot is below the strike, we will enjoy both these premiums. As the spot starts moving above the strike, now the loss will be double this amount. So it will now not be a 45-degree decline. It will be an even steeper decline because every 1 unit increase will cause a 2 units of loss because I'm short 2 calls. The third call I'm again long. It will have the lowest premium that I will have to pay, but as the spot moves above the strike, I will again start gaining according to a 45-degree line. So this is the payoff on the individual instruments. Let's now try to draw the combined payoff on the butterfly spread. We'll again plot it the same way. If S is less than K1, which of the options comes in the money? They're all call options again. So none of the option comes in the money. My payoff will again be a difference of the premiums. I lose this premium, I lose further this premium, but I gain these two premiums. So it can be a slight positive or negative. We will depict it as a slight negative. As the spot starts to go above K1, which option comes in the money? This first option that I was long. So again my gain will be according to this 45-degree line until I reach K2. So this will be the payoff until S is greater than K1 but less than K2. After this point, which option comes in the money? The first option remains in the money and these two incrementally come in the money. So there are now 3 options in the money. On the first one I will continue to gain. However, now I'm short 2 calls. The first short call will flatten my payout. That is, it will eat away all these incremental gains. The second short call will now cause a 45-degree loss because the gain is cancelled by the first and the second one will cause a loss. So as the spot moves above the strike, I will again keep having a loss until I reach K3. So this is when S is greater than K2 but less than K3. As the spot moves above K3, all options come in the money. So the incremental loss on this one option will be offset by the gain on K3, which I am long. So the payoff will again plateau out. So again the green dotted line is the payoff on the butterfly spread. Looks a little bit like a butterfly, hence we call it the butterfly spread. Please note, all these are long spread strategies that we studied. Whatever we studied was a long bull spread, long bear spread, long butterfly spread. If the question asks short butterfly spread, exactly the opposite. Whatever you are long, short it. Whatever you are short, long it. Please note, at some point the payoff has to become negative. So when you're depicting, don't depict everything as positive, otherwise that will be an arbitrage opportunity. So strategy can't be that it always makes a profit. There should be some possibility of a loss and some possibility of a profit. I'm not saying both sides have to be negative, but at least some negative has to be there even in your depiction. Just make sure, even though the values are not there. The next option strategy is called a straddle. Please note, this is not a spread strategy. So in a straddle, we simply long a call as well as a put option at the same strike price. So at the same strike, you long a call also and you long a put also. So you're long a call as well as a put at the same strike price. So at the same strike, this will be the payoff on the long call, and this will be the payoff on the long put. There is no reason that this premium should be lesser or greater. If you show it as equal to or greater for the put, that's also fine. So there's two possibilities: if S is greater than or equal to K, and if S is less than K. If S is equal to K, then none of the options come in the money. I'm long both. I will lose the premium on the call also, plus I will lose this premium on the put also. So my total loss is going to be the sum of the two premiums. As the stock starts going above the strike price, the call option starts to come in the money. As the spot goes below the strike, the put option starts to come in the money. So this will be the payoff on the long straddle. Now please tell me, what kind of a view is this person taking on the market? So this person is taking a view that whatever happens will be extreme. Either there will be an extreme up move or an extreme down move. A very common strategy around the general elections. Because the view is, if one party gets a strong majority, then the market will go up in a big way. If there is a big confusion, then the market will fall. Whatever happens will be an extreme movement. I don't know whether on the plus side or on the minus side. In a low volatility, or if the stock price doesn't move much, then the strategy will lose money. In a collar strategy, we combine a long option position, that is a long call position or a long put position, with a short option position. The idea is to subsidize our purchase. If we are longing a call option, then what is our view? We are positive on the stock. If we are positive on the stock, then can we short a put option? Because put will come in the money only if the stock price falls. So we already long a call, and to subsidize our purchase, that is the premium of this call option, we short a put option. So put option will make sure it's out of the money, so it's not a big risk, but some premium we'll receive that subsidizes our long call. If we are similarly long a put option, we can subsidize this purchase by shorting a call option. Again, shorting the call will get us some money so as to fund our purchase. If we are long a put, anyways we are expecting the stock to fall, so we can short an out of the money call. It will at least get us some premium that will subsidize this purchase. So that's a collar strategy that you must remember. An investor purchases a stock for $50 and a put for $2 with a strike price of $45. The investor sells a call for $2 with a strike price of $60. Let's quickly try to solve this question. Again, the same, compute the expression for the profits and at different points. So what are the different strike prices in this question? There's a strike price of 45 and there's a strike price of 60. So we know the ranges: S less than 45, S in between 45 and 60, and S greater than or equal to 60. Now there is a stock that has been purchased for $50. Under all circumstances, the payoff on the stock will be S minus 50. So that you can write up front. Doesn't matter where the strike is, S minus 50 will be the payoff on the stock. If the spot is less than 45, then which option will be in the money? There is a put option with a strike of 45 and there's a call with a strike of 60. So the put option will be in the money and the payoff will be equal to 45 minus S. It will be 45 minus S because you are long the put. So you will receive. The premium for the call and the put are given to be the same. I am short the call, long the put, so there will be no premium, or premiums will cancel each other. The call option is written at a strike of 60, so the call option will not come in the money. So the payoff, if S is less than 45, will simply be equal to minus $5. If S is greater than 45 but less than 60, which option will be in the money? None of the option, because the put has a strike of 45, it will be in the money when S is less than 45. Call has a strike of 60, it will be in the money when S is greater than 60. None of the options is in the money, the payoff will just be S minus 50. That is on the stock. If S is greater than 60, put is still worthless because any price of S greater than 45. However, the call will now come in the money, and unfortunately we are short the call. If we are short the call, the payoff to the long will be S minus 60, or our payoff will be minus of S minus 60, or our combined payoff will be $10. So this is the payoff on the zero cost caller, minus 5, S minus 50 and plus $10. So what is the maximum profit? If S is equal to 60 or anything greater than 60, $10 is the maximum profit. Maximum loss is minus 5. Break even price is when S is equal to 50. And similarly 0, 40 it will be minus 5, 50 it will be 0, 60 and above it will be equal to $10. So the exact same thing that we did, it didn't matter what the strategy was. That's how you'll solve any question regarding options. The last spread strategy, or the last strategy that we'll study, is called a box spread. So remember, a box spread is a bull call spread. So it is a bull spread made of call options, and a bear spread not made of call options though, a bear spread made with put options. Please note, as homework you can try to create all the spread strategies that we did using put options. Right now we did all strategies using call options. You can think and construct the same payoffs. Bull spread just means the payoff has to be, or the bear spread means the payoff has to be gaining in a bull market. A bull spread has to be gaining in a bull market. Upside and downside limited. It can be created with a put option. As homework you must try and create all these payoffs using put options. So a box spread is a bull call combined with a bear put spread. So this is the bull call spread, gains as market goes up, and this is the bear put spread, gains when the market goes down. Generally speaking, the box spread is a risk-free strategy. It should provide us a return equal to the risk-free rate of interest. An investor buys a call and sells a put with a strike price of $60. The call and put premiums are $5 and $2. The investor then sells a call and buys a put with a strike price of $70. For the second pair of options, the call and put premiums are $1 and $8. The options all expire in 3 months. Compute the profit and annualized return on the investment and determine whether this is a worthwhile investment if the risk-free rate is 8%. Once again, let's first try to depict the strike prices and let's try to compute the payoff from this strategy. So we see there are two strike prices, one of $60 and another of $70. So we'll have 3 cases to deal with. That is when S is less than 60, 60 is greater than or equal to S is less than 70, and when S is greater than or equal to 70. In all cases, the option premiums have been exchanged upfront, so we can calculate and write them. So there is a call that has been bought and a put that has been sold at 60. So minus 5 plus 2, and for the second pair where the call has been sold and the put has been bought. So for the call we'll get a plus 1 and on the put we'll get a minus 8. So the upfront investment needed in this strategy is equal to $10. So we need an upfront investment of $10 to enter this box spread. That is the difference of the premiums that we will have to pay. Now let's see under various circumstances what will be our payoff. If S is less than 60, which option will come in the money? Both the put options. One has been written on 60, one has been written on 70. Both put options will be in the money. So on the first put option that I was short, sells a put with a strike of 60. I will lose 60 minus S. K minus S is the payoff on a put. If you are short, you will lose. On the second that I am long, my payoff will be 70 minus S because I am long that put. So the total payoff is going to be $10 if S is less than 60, excluding these premiums, or if I take into account the premium, the total will be 0. If S is between 60 and 70, that is, it is greater than 60 but less than 70, one call will come in the money, that is the call at 60, and one put will come in the money, that is the put at 70, because it is less than 70 but greater than 60. The 60 call I am long. So on this long call, the payoff will be S minus 60. The second call, rather the put option, I am again long. The put at 70 I am long. So the payoff will be K minus S, that is 70 minus S. Again the total payoff will come out to be $10. If I take into account the premiums, the total payoff will be 0. Similarly, when S is greater than 70, none of the put options will be in the money, but both call options will now be in the money. The call option at 60 I was long. The call option at 70 I was short. So on one call option I will gain S minus 60. On the other call option I will lose S minus 70. When I sum it up, my payoff will again be equal to $10 after accounting for the loss of premium the payoff will be 0. So over a period of 3 months, come whatever, my payoff is going to be $10, and after I account for the premium that I have paid originally, the payoff is going to be 0. So I invested $10 because that $10 investment was upfront. Should I have invested the $10 in this box spread, or should I have just invested it at the risk-free rate? In this case, investing the $10 doesn't make sense. If the annualized return on the strategy was greater than 8%, please note this is a 3-month return. So let's say if $1 was coming, or let's say $0.5 was coming, then 0.5 upon 10 would be a 3-month return. Please remember to annualize it and then compare. If the annualized return was greater than 8%, then I could have gone in for the box spread, or I could have invested the $10 in the box spread rather than the risk-free rate. Generally, this strategy should give you the risk-free rate, otherwise there will be an arbitrage opportunity. So this is an example of an arbitrage opportunity. That is, I can short a box spread, receive $10 and invest them at the risk-free rate. I will gain 8% for free.